This is the second video in my two-part video series on the installment method of accounting. Now, do you remember Bill? He had that factory full of dump trucks. He manufactures dump trucks. And you remember Tom and his construction company and how Tom made an emergency call to Bill to get a bunch of dump trucks? Now, Bill has to account for all of this. I'm going to show you exactly how he does that. All right. Bill has a balance sheet account called Accounts Receivable Installment Sales. Okay? It is a special accounts receivable for installment sales that he does on a regular basis. Now, Bill did this installment sales thing for Tom because he trusts Tom. He knows that Tom has a business that is not doing financially well. But I'm pretty sure Bill and Tom grew up together. They've known each other for years, and Bill just trusts Tom that much to come up with this installment sales contract. Okay? So you're going to debit accounts receivable, this special installment sales accounts receivable for $500,000. And then you're going to credit an account. This is going to be on your income statement. Okay, you're going to have an account on your income statement. It's going to be in the revenue section. And it's called installment sales, and you're going to credit that for $500,000. Now then, what about the wholesale value of the dump trucks? Well, the wholesale value of the dump trucks is $300,000. So what you're going to do is you're going to debit cost of installment sales. Now, cost of installment sales is an expense account that you will find on your income statement. You'll debit that $300,000. Inventory, on the other hand, is a balance sheet account, and you're going to credit that $300,000 to say, hey, $300,000 for the dump trucks just went to Tom's construction company. Now, the thing is that the legal ownership of those dump trucks has not been switched from Bill to Tom. Why is that? Because Bill knows there's a possibility he may have to repossess those dump trucks. If he does, he still has the legal ownership. Just because he moved it out of inventory doesn't mean that he's given up ownership completely. Okay. Now then, let's say at some point through the year, Tom is able to round up $75,000 and put it in a bank account, and then he writes a check to Bill for $75,000. Okay. So Bill, at that point, debits his cash account, which is, of course, an asset account, for $75,000. He then credits accounts receivable installment sales for $75,000 to start removing this $500,000. Okay? Now, at the end of the year, Bill has to close out every single one of his income statement accounts to produce his balance sheet. Okay, so how does he do that? Well, first of all, he debits installment sales for $500,000. Okay? And that would close out this over here. He also credits cost of installment sales for $300,000. That gets rid of this. Okay? But there is still $200,000 left behind. So what is Bill going to do? Well, he creates a contra asset account called deferred gross profit, and he puts $200,000, he credits the $200,000 to help close out his income statement for the year. Boom. Okay. Now, what about the $75,000 that Tom paid Bill for this year? Well, $30,000 of that is realized gross profit. So what happens? Well, deferred gross profit gets credited $30,000. Deferred gross profit gets credited $30,000, and then realized gross profit gets debited $30,000. And the realized gross profit is an income. It's a revenue account on an income statement. It's a revenue account on an income statement. And so therefore, deferred gross profit gets credited $30,000 and realized gross profit gets credited $30,000. And that's how that works. Okay, so what happens next year? Let's say that Tom is now able to round up another $100,000 to send a bill. Okay? Well, the following year, cash is debited $100,000 and the accounts receivable from that installment sales is credited $100,000. But what about the gross profit? Okay, well the gross profit here, okay, is 40% of $100,000, which happens to be $40,000. So deferred gross profit would be credited $40,000 and realized gross profit would be deferred gross profit would be debited $40,000 and realized gross profit would be credited $40,000. That's what would happen. And that would go on every single year until all $500,000 is paid up. You see? All right. I will tell you more in a future video, so I want you to stay tuned.